Peter, tell us about fat and flat, what it is and why it's important.
Well, the idea here is that you have, in all probability, an outcome this year for equity markets which is fat or a wide, volatile trading range, but a relatively flat return. Yeah. And the reason for that is simply that in recent years, most equity markets have gone up a lot, mainly because of valuation expansion as interest rates have moved towards zero and QE has come through. So they started with a relatively high valuation, and we think profit growth will be positive but not that strong, and so you get a relatively flat return but lots of trading opportunities.
So Peter, does that mean you trade the ranges contrary to what fund managers like to do, where you invest for the long term?
Yeah, I think it's likely to be an environment where there's less beta, less index-driven return, and more opportunities to trade the range, but also more differential beneath the surface of the index.
It can go badly wrong, though. We were just reporting on Pershing Square, two big investments that Bill Ackman has had, which means he's now down 20%, and we've only gone through 2 months of the year so far. So if you are invested in a couple of small exposures, given all the volatility you're citing, it suggests a lot of risk for investors.
Well, I think that risk is being reflected to some degree in the way that the market is moving, relatively high volatility, but also quite a high risk premium. In other words, the prospective return, at least relative to a risk-free rate, is pretty high, and that, I think, reflects the uncertainty about long-term growth and also inflation, which I think is another really important factor.
Volatility too, couldn't there? If you look at the euro, sterling, renminbi, yen, dollar nexus, we've had a huge amount of volatility just in the first 2 months of the year. You know, look at the Boris Johnson effect on the pound. I personally think it's a very good thing that the pound goes down a bit, but that you will have a lot of rocking around with the euro as well. That's going to get into really negative territory, I think, in the course of the next few months. So that's another element, isn't it, in your story of the ranges. The ranges are going to be pretty colossal, I think.
Go ahead, Peter.
I think one of the other crucial points, though, that underscores this is this uncertainty about whether we're really in a deflationary world with secular stagnation or something a little bit more benign. Our own view is that it's more benign, that the market is overpriced deflation. But the uncertainty about which of these two trajectories we're in is causing
with your view versus what central banks are thinking. So if it's just a benign inflationary environment that we're seeing, not deflation, why are we in negative territory with interest rates here in Europe and elsewhere in Japan?
Well, clearly there's a desire to continue to have a very accommodative monetary backdrop, and that's consistent with output gaps and with low inflation and the determination to tackle that. But I think, as we've seen in the most recent data in the US, you have got core inflation that's still positive, and the markets have priced something a lot more negative than that.
I think there's a problem actually with this different definition, because we've got disinflation in Europe, and actually that is part of the solution to the competitiveness problems that we've had in countries like Spain. We were talking about high unemployment. People don't seem to realise that it's not just low oil prices, it's actually the fact that you've had a huge binge in continental Europe and it's been squeezed out of the system. That means inflation is very low in lots and lots of countries.
But that's not how the ECB has to tackle the problem, because they've got price stability that's front and centre as an issue.
But actually, Karen, it's really interesting to look back at this, because when the ECB was formed in 1998, they set the definition, they interpreted price stability as inflation between 0 and 2%. They then reinterpreted that in 2003. They could, if they wanted to, simply go back. I mean, unlike in other central banks, which I think is really bad, the ECB is judge and jury. They decide themselves how to interpret this price stability goal, which is in the treaty. They could, if they wanted to, simply reinterpret the inflation goal, no longer close to but just below 2%. They could go back, if they wanted to the old definition between 0 and 2%, and they are hitting that target.